The European Central Bank has vowed to keep interest rates on hold at record lows and says it won't shy away from stimulus if the Eurozone economy continues to suffer from a slowdown. The ECB has left its benchmark rate at zero and the deposit rate at minus 0.4% at its policy meeting on Thursday, as it grapples with growing concerns about weak inflation. Inflation rates fell sharply in May to 1.2% from 1.7% the previous month. That's well below the central bank's target of just under 2%, which hasn't been reached since 2013. And while the ECB raised its outlook for Eurozone growth this year to 1.2%, it lowered the forecast for the following 2 years to 1.4%, blaming geopolitical factors, protectionism and vulnerabilities in emerging markets.
We decided to keep the key ECB interest rates unchanged. We now expect them to remain at their present levels, at least through the first half of 2020. And in any case, for as long as necessary, to ensure the continued sustained convergence of inflation to levels that are below but close to 2% over the medium term.
Well, for more on the ECB meeting, David Madden joins us now from London. He's an analyst at CMC Markets. Welcome back to Money Talks, David. What did you glean from Mario Draghi's extensive press conference? How worried is the ECB about the Eurozone economy?
In my opinion, they're not as worried as they should be. Going into this meeting, there was a lot of speculation that the European Central Bank were going to take a very dovish tone. Now, if you look at the big picture, the Federal Reserve, which is kind of in a way the world's central bank, the Central Bank of the US have done a lot of changes to their language in recent weeks and months. They're now open to the idea of interest rate cuts at the back end of 2019. Keep in mind, we've seen interest rates come down in India, also in Australia. So you'd imagine the Eurozone, who were in economically a worse position than the US, you'd imagine at the very least they would actually adopt more dovish language to try and keep up with other central banks around the world. But they seem to be quite neutral, and they were certainly nowhere near as dovish as some traders were predicting. So that's why we saw a rebound in the euro, which in turn made Eurozone stocks more expensive. So we saw the DAX over in Germany and the CAC 40 in France push lower on the back of it.
Yes, and many people were looking out for signs of stimulus, weren't they? Namely, whether or not the ECB would restart its huge bond buying program, multi-trillion-dollar program, which ended last year. Do you think the central bank will go down that path again?
I think they're going to have to, and to be honest, I'm surprised that they haven't quite frankly admitted that they shouldn't have wrapped it up in 2018 when they did. They thought they were kind of off the hook when they saw that the United States was pressing higher with interest rates, but obviously now the tide has turned. There's concerns particularly about trade. That's a major issue that's been hanging over economies. We've already seen the slowdown effects to some extent in some economies, and now we're in a scenario whereby the ECB are just kind of, in my opinion, just hoping that things will actually just pan out okay. Bearing in mind they've only kind of so many rounds in the chamber, as it were. So the European Central Bank, if they do proceed to have another bond buying scheme, which I suspect they will, they're probably going to only do it when it's absolutely necessary, and they want to make sure they get it right this time.
And do you think they'll look to use other policy measures, other stimulus measures, before they look at that bond buying program?
Absolutely. They've already announced a third go of targeted liquidity, which is essentially a scheme which really encourages Eurozone banks to go out and lend to consumers, to lend to businesses, and it's very beneficial for banks to do that. And the more banks lend out, the more beneficial it becomes. But the problem is this: the Eurozone, be it individuals, countries and companies, are already extremely indebted. So it's all well and good offering cheap loans and encouraging loans, but I wonder actually when many people or companies want to actually take on additional debt, especially in light of falling inflation, which is a sign demand is declining.
Okay, David Madden in London, thank you for your insights as always.